Okay, folks, welcome back. This is our weekend review for the ICT Mentorship, July 12th, 2020. We're going to do things a little bit backwards so we can work from the lower time frames up. We're looking at the dollar index as our 15-minute time frame. All right, so we had a run from this optimal trade entry in here, came back up inside of the equilibrium of this trading range in here. I'm still interested to see if this wants to roll over on the downside. We still left in place a higher low than this low here, so we do have qualifying relative equal lows. Do we need to go a little bit higher and trade maybe up into this small little fair value gap right there? So does it trade there and then reject, or does it gap down, trade back up and go lower? Either one of those scenarios I'm watching. I don't want to see it trade back up above this high. Okay, I don't want to see it. It would be better for it to leave this buy side liquidity intact. Let it come back here, not run this, and break lower. That would be a better scenario for my liking. We are at the lower end of that daily BISI. So again, these levels are relative to that daily buy side imbalance, sell side inefficiency. So it's acting as short-term resistance still, much in the same way I was acting as short-term support here, and just working around those levels. I want to see it get below here and work towards these higher time frame objectives as I outlined before. So let's look at the hourly chart. All right, so here's the hourly dollar index. The fact that we traded back up into this last up close candle right before we dropped lower, we are inside of the tail of that candle with this price action in here. If we get one single attempt to get above this short-term high and then rejects lower, I like that. I don't like the idea of coming down below here, filling that in, and then going higher. If it does that, then we're probably going to work back towards this area right in here. So have that on your chart noted. So this would be a more appropriate level for the buy side liquidity. I'd like to, again, see this remain intact. This coming back up in and then working towards another breakdown lower is what I favor going into this week. Do we see it? That remains to be seen. But we do have this buy side imbalance, sell side inefficiency. It was rebalanced here, and now it becomes a balanced price range because we went both directions. We had the imbalance here, down, up. So now it could break down lower. So what you want to do is to have your chart indicate that range. In here, how it's completely balanced that. So if we leave this and take this low out, there should be no reason to come back above the discount end of the BISI on that daily chart. And again, if you forgot what these levels are, it'll become more apparent and clear when we get to the daily chart, which will be next. Let me get this off here because otherwise it'll drive me nuts. All right, so here's the dollar index daily chart. And as you can see, we are still in that consolidation. And the only reference points that I've been finding of any value is that old buy side imbalance, sell side inefficiency. And again, so you can see what those levels are. It's this one single candle that passed out, creating a buy side imbalance. Sell side was offered, then buy side, and now we're back into it again here. So how many times have we passed back and forth inside of this old imbalance? Multiple times. So there's really no need for it to go back up. If it goes back up, then consider here for a longer term perspective, and maybe even back up to here. Now again, that's a lot of assuming on my part, so just take that with a grain of salt. Nothing says that we have to even leave this consolidation yet, but I would prefer, if we're going to put a gun to my head and say which side do I want to see it really take out this short-term low and make an attempt to get down here. Now how we get there from right now as the chart sits is what I outlined on the 15 and 1 hour charts. Those are the conditions and the circumstances that I would favor for the dollar going in. Now, if we start the week and it just starts to take off and take out short-term highs on that hourly chart and 15-minute time frame and shows no willingness to go back down, then again, just focus on the 97.34 level, the premium end of that buy side imbalance, sell side inefficiency. Okay, that's probably what we'll try to reach for this week if we don't show, again, immediate weakness going into the week. But if we lose this low now, this low will trigger a large range that would take us down into here. We might get a little bit of a bounce at that rejection block here, which is the down closing price. In other words, where this candle's close, look right here. Okay, right here. So 96.05. Watch that level. That may be sensitive because it is a rejection block. It can have a little bit of a bounce in here, but I don't want to see it, if it goes to that point, come back up to this level here, the discount end of that old BISI on the daily chart, as you see here. That's the business on dollar index. Let's go over to euro. All right, so I'm going to teach you something in the euro dollar here that I utilized last week, and this is my failure to launch entry. If you go back and watch the videos, or simply have it in your notes, you know that I said that we could probably come down in here, but we didn't want to see it go below that, because if it did go below that, it's problematic, and we'll probably run the sell side liquidity over here, and that ended up becoming what we saw. Initially, I wanted to see it try to make an attempt to get up into those 114s, but we lost ground. Dollar moved back up into its daily BISI, which makes the foreign currencies bend the knee here. And euro dollar, we outlined all this business in here. I'm going to focus just in here for right now, just for the teaching portion of the weekend review. So we have the imbalance here, and it's showing the candle's high here and this candle's low. Now, originally it would have been this candle's low and this candle's high, but we had a rebalance to this point here, leaving this small portion as highlighted. So I'll show you a little bit more clear. Okay, so you can see the top of that candle and the low of that candle. That's what I'm highlighting, that little area right in there. Inside that area, there should be a run higher, because we went into this area here and then it should rally. So on the 15-minute time frame, we're going to reduce it to a 5-minute chart, and then we'll come back to the 15 and clean up this portion of the analysis. But I want to add this right away because some of you were probably confused as to what led me to that 113.10. All right, so here's the imbalance again, refined to a 5-minute chart, but this is all based on the 15-minute time frame, but it's 5 minutes showing here. Failure to launch is simply this. We had relative equal lows in here, old low here, imbalance. I said that it could potentially go down there, but if it did, we would rather see it rally. At least that's what I was co-signing on last week. So when it traded down in there and filled it and started the rally up here, initially my gut, I guess, my desire, my focus, my plan was to see it rally up and then create some kind of an imbalance so I can buy it here. If I was wrong, there are instances where that if it does certain things in price, I can utilize a stop order where at 13.10, which is down here, after it filled in and rallied back up, this could have been the ideal short. I wasn't looking to be a short. I wanted it to be a long. But as an insurance policy, what I can use, and now you're learning, is a failure to launch entry. So inside this area that should have been a point of which the market should have rallied and went higher based on what I was given in terms of analysis last week, the market shot back up. It created an optimal trade entry for a short, but I didn't feel comfortable with that, so I wanted to use a stop order at 113.10. So if 113.10 gets hit when the market's up here, I'm sacrificing the ideal entry in here, but using a point of which once it hits that, it's probably not going to turn around or dilly-dally around like it did in here. It leaves this area, aggressively moves below this low, So the logic behind this is it fails to launch on my predetermined bias, where I had co-signed with the idea that it could potentially go into the 114s, even allowing to drop down into here to rebalance. Once it rebalanced and showed a willingness to go, so it's already taking off. That's ideal. We want to see that. But in the event that I'm wrong, because it's at a point where if it trades back down here, it's probably not going to go higher. That's what failure to launch entry is. It's just a way of saying, okay, I have an opinion about the marketplace, and while I do expect it to potentially rally or decline, it's the same thing is said for going short, but there's going to be points in which in price action, and I already know some of you are going to say, well, how do we know that? This is all going to be lessons that you learned that are part of algorithmic theory. Okay, but I have to introduce it by slowly segueing into it. And you'll have all kinds of rules for these types of things. So it's not like going to be a pure experience factor. There's certain things that the market will do to signify that it's probably going to a point of reversal, and you can utilize methods like I'm showing you here. Okay, so 113.10, sell stop. Now, there's no open position at this point up here. Again, I'm not saying that this isn't the better entry for going short. I'm just saying that at this time, I wanted this to be more productive on the upside. But in the event that I have it wrong, this is a ace in the hole where it's allowing me, I guess, a way of capturing the market when I'm wrong. Okay, and this is what I'm outlining here. Inside of this area that would otherwise be a point of which where it should be rallying after completing a rebalance to this area here. So that's our fair value gap. It comes down and reacts. But I don't want to be a bear. But I have to either completely stay out of the marketplace or use a failure to launch entry. And that means it's going to have to go back down to an area where if it goes back to here, I'm wrong. But now, where's it going to go to? Let's zoom out a little bit. These old lows over here and here. So if I'm trying to enter up here, between here and the area below here, that is an opportunity for me to capture pips. 50 pips, right? The framework is from here, below here, I'm trying to capture 50 pips. That's the bottom line. So if I can't get the 50 pips on this run, and I'm probably wrong, then I can use failure to launch entry, which is a sell stop when I'm trying to look for a long. But if the long idea fails, this puts me in, because when the market trades down to 113.10, that sell stop order, since I don't have a long position, it triggers me short. Whereas otherwise, if I went long here, my sell stop would be below here, and it would just get me out of the long position, and I would be flat. In this instance, failure to launch, for this framework, the sell stop is used to get me in once price trades to that price level. And it trips me in short, and then I ride it out and wait for it to break below here. And you see that happen there. It runs below it. The low comes in at 112.54 in 9 pipettes. We'll just call it 112.55. My limit order was 112.60, and you can see that got hit. I showed you that on Twitter on Friday. Beautiful little short. Again, it's one of those working class hero approaches where if you think something's going to happen, but you don't feel 100% confident about it, but if it does go down to another level, that would change your bias or your view on the marketplace, and it offers a framework where you can capture some pips. That's the ideal scenario for failure to launch, but it's not going to be completely understood here. I'm just introducing the concept because, like I said, I have lots of tricks and approaches to entering and setups, and the logic behind it has to be taught, and you have to see certain things over and over again. We're getting there. We're actually getting to the good stuff of the mentorship. So just make sure you have an area in your journal where we have failure to launch entries and leave room in there for the logic, because we're going to slowly start working towards that as we get into 2021. But here, that's basically the criteria I used for that trade. And let's go back out to a 15-minute time frame and finish off euro. All right, so there's a few things in here that have me concerned. If we lose this low that was formed on Friday, so if we trade through that, your eye should go down to here. Okay, so there is no sell side liquidity here anymore, in my opinion. It's residing down here. So the largest pool of liquidity for sell stops is below here. If we lose this low, same scenario here to here, I could potentially look for that same setup to run below here. But I don't want that really to happen. I want to see euro trade higher and dollar weaker. That's what I'm looking for. Now, understand what I'm doing here. I'm not forcing my will. I'm just giving the opportunity for the market to give me those confirmations, those signatures in price action. If they don't have it, then that's fine. I'll do nothing. Or if I'm wrong in my outlook, I can use tools like I just taught you here and trade it with a live account, where if I'm backwards in my thinking in terms of wanting to be bullish, and the market gives me a clear indication I'm wrong, there's two things to do. Nothing, stand on the sidelines, risk nothing, or flip your bias and then see if there's a structure in play that you could capitalize on and catch 20, 30, 50 pips or more. But in this instance, because we're in a large consolidation, I'm only looking for runs below old lows or above old highs. That's it. That's how you trade consolidations. And it pulls back to the middle. So where we are right now, I like the idea. It came back down into this fair value gap. It touched, only went one pipette below the low here. So if you look at the low, 112.73 and 8 pipettes, and it went down to 7 pipettes here. There, 112.73 and 7 pipettes. And then we have the reaction. Boom. That is institutional order flow entry drill. Okay, it's a mouthful, I know, but all it is basically going long on the same low plus spread, and then you capture that run here, and it returns back to the bearish order block. Now we have a run down initially on this candle, and then this candle we break down again. That's what I'm saying, that failure to launch helps you capture, because once it goes down here and comes back up, there's really no reason for it to go back down here unless it's going lower. But we came all the way back up to a point of bearish order block after doing 2 passes in this area. So if it can climb outside of this high, again, going higher, and we've already rebounced to this point here and returned back to the consecutive down close candles here, which is a one solid bullish order block. We had 1, 2, 3. So if we are able to rally higher and clear this high, these highs here should offer really no resistance whatsoever, and we could see 114s this week. If we take out this low, then it's probably going to start working aggressively down into here. So there's my lines in the sand for euro dollar. Let's go to the hourly chart. All right, so there's the hourly euro dollar. You can see we came down almost to consequent encroachment of the range between here and here. And I just, like I said, I want to tell you that it's going to do this or it's not going to do that, but we are in this prolonged consolidation, and it's 50-50. So it depends on what the market's doing in the individual trading sessions. Like, for instance, Asia, London Open, New York Open, London Close, those specific times of the day. Asia being 7 o'clock to 9 o'clock in the evening EST, and London 2 o'clock in the morning to 5 a.m. EST, New York 7 a.m. to 9 a.m. EST, and London Close 10 to noon EST. So those individual time periods is what I'm really focusing on scalps intraday right now. That's all I'm really favoring. I don't want to see any of these trades like turn into or morph into, like I talked about on my most recent YouTube videos, turning a very short-term scalper's market entry into, well, now it's a position trade. Because if that's what you end up doing, if I would have stayed short rather from here and waited for more of this to be traded and not got out where I did, then I would have been upset having to ride all that back. I don't like to do that. Now, typically I'll get stopped out before this much of a move occurs on a position of mine, especially after going to a target where I was looking for. So you want to be moving your stops and controlling your trade management to a point where from your entry, once you get first target, it should never come back to your entry and stop you out. That should never, ever, ever happen. So you should be banking something or completely taking your positions off and adjusting your stops so that way you're 15, 20 pips in, and even if the market turns around, you've taken something off on the final bounce and not just, I took a partial off, but it came back and stopped me out and I made nothing on the remainder. That's a no-no. We don't do that. All right. So again, just write it out on your notes for this week so that way you see it every single day. We are in low probability. That means I'm probably going to be wrong. And I want you to understand that I'm probably going to be wrong because it's 50-50 here. I can see both sides of the marketplace, but I'm telling you which side I would prefer to unfold. By doing that, should it happen, then it'll be easier for me to find and pick my spots and show you what was likely to occur going into Friday. As it is right now, it's up in the air as to what it may do because it's a scalper's market. So it's frustrating. It's not what you want to hear because if you're a short-term trader, you want to know, okay, it's going to trade 75, 80 pips, 100 pips to this point from here. We will get those conditions and those environments back. But right now, we have to work through the summer doldrums and all this other rigmarole. So those are the things I want to see for Eurodollar on the hourly. I want to show you now the daily, and then we'll move over into cable. All right, so here's what we got for Eurodollar. We have this long consolidation we haven't left out of, and it's very frustrating. It's extremely frustrating. Let me take all this lipstick off for a moment. While we're in these consolidations, it just stinks because you want volatility. You want to see things moving around. Movement creates ease of running liquidity, entry, and finding opportunity. In this range here, if you don't know what you're doing and you're really forcing a lot of hope and wishful thinking, you could really blow your account quickly. And everything in this market environment right now, I see certain things that would otherwise in other environments create an obvious one-sidedness. For instance, we have this high and we have multiple highs in here, but I would have rather seen Friday really break down if that was the case. In other words, all of this in here basically being distribution. And in another environment, not in these prolonged contractions like we have now, I would have already been short on Euro with an expectation that it would trade down to here. And I've already talked about this level in previous recordings. So if we do break down, then fine. I will have plenty of range to get down to this particular fair value gap. Even if we have a big down close candle, it won't change anything. It still would give us a lot of room to capture pips to get to here. My gut tells me that they're holding dollar longer in this area and it may erode. And if it trades lower, this will send Eurodollar sharply higher than here. So in other words, we went to this level, we started to come down, we rallied back up, and then this is where we should have just dropped. It didn't. It just keeps moving higher and higher and higher and higher. And to me, it just feels like one of those instances where if you try to short this, it's going to burn you. And it just feels like every time someone sells short or anyone's positioning, look what they're doing. Every high is being taken out, but they're doing it in a very small consolidation. And that to me feels like a trap because it feels like every time they're doing it, it's just baiting more people to get short. And then we're going to probably see a large range candle on the upside. I'm not going to be surprised, but I'm expecting that. Now, I could be wrong, and it could be a large down close candle. And guess what? That's fine, because then I'll change my bias and I'll look to here. And if I take a trade and it loses, fine, I don't care, because that boo-boo will get sorted with a move that goes down to here. I'm not worrying about being wrong. I'm not worrying about losing. I'm not worrying about having my analysis wrong, because I've already admitted to you, when it is a 50-50, you're going to know about it. Look what we've been doing. You've known about this consolidation and the likelihood of it continuing for weeks now. For weeks. We're not surprised by this. Okay, so if you're month one to transition to month two, you're seeing that we do have visibility in terms of environment and market profiling. That's something that 90% of other educators out there, they don't have any skill set in that. It's just, what's the chart telling me to buy or sell right now? And you have to know and filter when to dial back your frequency. And also be willing to admit when you're wrong or likely to be wrong. Because if you don't understand when those environments are going to create those circumstances for you, you won't be aware of it, and you'll lose control, and revenge trading, back and forth, 15 different trades in the same day, both sides of the directions, 7 longs, 8 shorts, all of them losers. Okay, that's what I was doing in the 90s. Okay, I did a lot of that because these environments would chop me up. Okay, I was wrong going long, it's pulled back. Okay, let me turn it and flip it, and I'm now going to go short. Oh, it stopped me out, or it's moving against me. Let me get out. I'm wrong. Let me reverse it. If you've done any live trading, and you've probably done this type of stuff in these last few weeks, if you're new, month one, or now month two, because there's no month one now because everyone's transitioned, you probably can relate to what I just said. And you're probably looking at your account saying, yeah, that's me. I've done a lot of trades, and they were all small losses, but they were deaths by 1,000 cuts, and you've chopped up your account because you're trying to make something out of stagnant price action. That is wisdom. That comes from being here in the mentorship. It isn't just watch a video. You have to be with me. I have to hold your hand and say, this is what's likely to occur. And again, I'm not 100% right, but I am really high up in terms of my visibility, and my track record's there. You can look at it in archives. I don't go back and edit anything. So when I'm wrong, I'm wrong. And I'm telling you that in this environment, I'm probably going to be wrong. So if you see something that agrees with you and your trade idea, don't look at it as me supercharging the idea and then it's now going to be high probability. We are in absolute low probability conditions. This continuation sideways can continue. Okay, that's the point. That's what I want you to understand. We're waiting for an obvious displacement higher or lower and leave this range. Okay, it could come down and take this low out and then scream higher. And that in itself would give us displacement. Right now, we don't have it. So only thing we're doing now is forecasting with a 50-50 likelihood that I'm probably going to be wrong. And it's important for you not to buy into the analysis 100% and plunge into live trading. Okay, I tell you every time, don't trade with live funds while you're in mentorship, while you're learning, because why are you doing anything with live funds if you don't understand what you're doing? This environment more than any, please listen, don't risk live money. Because if I'm wrong, there's going to be valuable lessons from that you're going to glean, and you won't be taking money out of your account for you to get that lesson or that insight. I'm 100% confident that with this period in time, once we leave it, I'm going to go back to doing 98% strike rate. I'm going to be on it. But in here, I know my limitations. I know what IPTA's trying to do, and I'm waiting for specific signatures, and when I see them, I will point to them and I'll say, this is what we've been looking for. This is what should happen. And it'll be back to business. But right now, we have to wait for this market to leave this consolidation, or just be happy with 10, 20 pip scalps intraday and just doing 15-minute, 60-minute stops on old highs and old lows. That's it. That's all you're doing. Small little short-term intraday low resistance liquidity runs. Not requiring daily bias, but just using intraday volatility. All right, let's go to cable. Here's cable, 15-minute time frame. Really nice consequent encroachment of the gap in here. It goes right to the middle of that. Beautiful. Do that on your own chart and you'll really appreciate how sensitive that was. We have relative equal highs in here, and again, I'd like to see it move higher. Even though it looks like it just wants to roll over, I want to see dollar trade softer and cable ramp higher. I think cable's showing relative strength to the upside. It has done so this week. It's performed more on the upside with better structure than euro has. I like the idea. We traded down into here, and this, you'll see what this is when we go out to an hourly chart. So we have multiple optimal trade entries in here, and the delivery has been running out short-term highs for buy-side liquidity. That means every high gets traded through, every high gets traded through, and we have now relative equal highs. So the current institutional order flow for cable is bullish, and we want to see it remain intact. Going out to an hourly chart, okay, and again, the range is the high to low, and this is equilibrium. We're above it. We had a nice reaction at equilibrium, and we're trading back down into here. So I want to see it work its way above here and the equal highs that we've already formed here, and then try to drive for that 128 big figure. If we lose this low, your eye has to go back down to this area in here to completely close in this buy side imbalance, sell side inefficiency, and the sell stops that would be resting below that short-term low. If we lose this, then we're going to potentially trade all the way back down into here, and then that would set us up for contention on these relative equal lows, and that would indicate that dollar is extremely bullish, and we're probably going to go back into the $1 mark if that happens. I just don't know right now, but I like the idea of staying net long on British pound. Even so, I want to see this low stay intact and not be violated on the downside. And finally, moving into the daily chart. Should we get above here, and again, it's a lot of assumptions, but if we trade above this high here, I've mentioned this already, that's a fair value gap right there, and if it trades there, I don't think it's going to stop. I don't think it's going to go here and go lower. I think it's going to go there and then expand and run the buy side liquidity resting above these relative equal highs. Now again, it's an odd pattern, it's odd market structure to do that, but we're in an odd market environment. Okay, and there's nothing like this. They've not shut the world down before. Okay, and things are going to be in need of serious ironing out. So just keep your trade frequency or expectations very, very low. We are still in a consolidation on here, but the relative strength of cable versus euro is undeniable. You can see it wants to not go lower, and that's typical of British pound. It's very stubborn. It does what you think it's not going to do, and it does more than you thought you was going to see. So it is what it is. So we're going to watch and see what Monday's trading does, and if it gives us any more insights, obviously you'll note Monday evening when I do the daily upload. But the main takeaway this weekend edition was introducing the failure to launch entry, and I'll give you more context and theory around that as we work towards introducing more entry concepts and utilizing it with specifics in market structure. Enjoy the rest of your weekend. I will talk to you tomorrow on Monday upload.